everybody. We hope everybody's enjoying their last couple weeks of summer. We provided a market commentary a few weeks ago for quarter three, but given that we're in the heat of earnings season, we wanted to provide a video update to accompany it. So we've seen about 80 companies report earnings for quarter two thus far of the S&P 500, so about 400 companies. Of those 400 companies, 327 have outperformed earnings expectations. This is a great number, great headline. We've gone back and looked at it. Take it with a grain of salt. However, a lot of companies revised their earnings expectations, as well as a lot of analysts revised earnings expectations for these companies back in April during the heat of a lot of the tariff noise, economic uncertainty, supply chain, things like that. So they set the bar pretty low when it comes to earnings and profitability. Now, it's great news that 82% have outperformed earnings. However, again, take it with a grain of salt. One thing that we can ascertain from earnings reports is technology continues to be the trailblazer. They're really in a league of their own. Okay, companies like Meta, Microsoft especially, those two knocked it out of the park when it came to their earnings report. And each of them are hitting all-time highs. Amazon had a great quarter as well. And the reason for this and why they're performing so nicely, these companies have spent a lot of money on AI, billions of dollars on their AI spend, capital expenditures, and software development. And quarter two really provided information that this big AI spend that they're doing has resulted to real dollars, for them. We've gone back and looked. The top 50 companies, and actually they spend the most on AI, the top 50 companies, big tech, so far are producing 50% of the overall profit in the S&P 500. So top 50 companies are generating the top 50% of profit for the S&P 500. The other 450 companies are doing the other 50%. But again, the biggest companies are producing the most profits. No surprise there. Two things that we're seeing right now. We're calling it a K-shaped earnings results. What I mean by K-shaped, the companies that are providing the clearest path forward, best business plan, most transparent business plans, operational efficiencies are going up, are doing very well. Companies that aren't providing clear expectations, that aren't providing a clear path forward, are talking about tariff uncertainty, supply chain uncertainty, are going down. So again, that K-split is currently what we're seeing in earnings. Okay. The theme the rest of the year, let's look forward. The theme the rest of the year, what we're calling is don't be afraid of heights. Okay, what do I mean by that? We're near all-time highs right now for the market. That doesn't necessarily mean that there's going to be a downturn. Okay. Momentum typically leads to more momentum. All-time highs tend to lead to more all-time highs. We're going to put up a graphic here in a second and two data points on this. The first data point, we're comparing the market looking forward 1 year, 3 year, and 5 year when the market's at all-time highs versus 1 year, 3 year, and 5 year when the market is not at all-time highs. And what you'll see is when the market's at all-time highs, on average, outperforms the forward-looking results when the market isn't at all-time highs. So again, we're just highlighting that just because we're at all-time market highs doesn't mean the market is going to go down or is going to have a retraction. Now, I think we'll see some volatility the rest of the year, but like we mentioned in past commentaries, volatility and being able to absorb volatility, that's the price to be paid for performance, for growth. Okay. Second data point, this is a great data point from Ryan Dietrich, chief strategist at Carson Group. We've had a big whipsaw in performance the last 3 months. Market was down 20%, near 20% in April. It's up 25% the last 3 months. That type of performance we've seen 5 other times in market history. All 5 times, the market was higher 1 year later. On average of those 5 times, the average performance of those 5 times 1 year later, 22%. So phenomenal numbers there. We can't use that as a predictor for the future, but again, very powerful figures. If you have any questions about your account or any headlines that you're seeing, always feel free to reach out. Happy to talk to you. Happy to hear your thoughts. But again, hope all is well. Take care.